All right, so that's it for permanent policies right now. Now let's switch over to term. So term is different than permanent. Term is temporary protection. It only provides coverage for a number of years specified in the contract. That could be like a 10, 20, 30-year term or anywhere in between. I'll use 20 years for some examples that I'm going to give you along the way. So it is temporary protection. Term also differs from permanent policies in that term is called pure death protection. The only reason somebody purchases a term policy is there's a death benefit that would get paid out if the insured dies. There are no other benefits to term insurance, which means there is no cash value to term insurance. Make sure you know that concept. No cash value to term insurance. All right, there's 4 different types of term insurance that we're going to talk about. First, let me go ahead and start with annually renewable term. It's also called ART. Annually renewable term is the purest form of term insurance. You prove insurability when you first take the policy out. However, every year your premium will go up because every year when you get older, you are attaining a new age. So you need to know for your test that annually renewable term is called an attained age policy. Attained age means how old are you now? That is your attained age. How old are you now? So in an annually renewable term, your premiums every year will be based on your attained age. These next 3 forms of term insurance, and this is going to be very, very important for your test: level term, increasing term, and decreasing term. These 3 forms have everything to do with the death benefit of a term policy, which means they have nothing to do with the premium of a term policy. Very important concept. It's either a level death benefit, an increasing death benefit, or a decreasing death benefit. So let's walk through these real quick. So level term, it's a level death benefit, provides a level death benefit and a level premium during the policy term. So once again, I like to use $100,000 as a death benefit. So starts out at 100,000, ends at 100,000, level death benefit. Next is increasing term insurance. And remember, on increasing term, it is the death benefit that is increasing, not the premium. It's the death benefit. This is going to be 1 billion% word association on increasing term insurance. You need to associate increasing term insurance with a specific rider that could be added to a term policy called a return of premium rider, or ROP. Because when the return of premium rider is added to a term policy, it says that if the insured should die anytime during the term, not only would their beneficiary get the $100,000 death benefit, but they would get all the premiums that had been put in up to that point. So instead of it being a level term policy, it becomes an increasing term policy because the death benefit has to increase every time a premium payment is made. Let me be very clear for your test. The only time you will ever pick increasing term as the answer is when you see return of premium rider in the question or vice versa. It will never be your answer unless you see return of premium rider. Next, we have decreasing term insurance. And remember, once again, it is the death benefit that decreases in decreasing term insurance. This is also word association for your test. You need to associate decreasing term insurance with a specific type of insurance called credit life insurance. So credit life is coverage written on the life of a debtor to a creditor. Now, the creditor is the policy owner and the beneficiary. The debtor is the one that's insured under the policy. If you have ever gone to a bank to get a loan, most likely they've had you take out a credit life policy, whether it be a car loan, a house loan, or a business loan. It has nothing to do with protecting the creditor, the debtor. It has everything to do with protecting the creditor. Because if the debtor dies before the loan is paid off, then the creditor still wants the money that's owed to them. So there's a credit life insurance policy attached to that loan. Credit life is written as decreasing term insurance because the death benefit of it has to decrease every time a payment is made on that loan. The creditor is not allowed to gain financially from the insured's death. They're only allowed to collect the amount still owed on the loan. So on your test, this is very important. If you have any type of question about anybody going to a bank to get a loan, stop reading after you see somebody's going to a bank to get a loan and look for either credit life or decreasing term insurance. There is no other answer right now that it could be. I'm going to give you one other one in a later video, but right now, if somebody goes to a bank to get a loan, it's either credit life or decreasing term insurance. And then we already talked about annually renewable term being the purest form of term insurance where the premium increases every year. And remember, annually renewable term is an attained age policy. Now, let's look at provision that was going to be found in every term policy. This provision says that at the end of a 20-year term, or however long the term is, that the insured has the option of either letting the coverage go and not having it anymore, or they could renew it, or they could convert it. Let's say they wanted to renew it at the end of the term. Well, they're going to renew it for another term policy, and they can do that without evidence of insurability. So they don't have to, even if they have some health problems, they do not have to prove insurability. Or they could use the convertible provision and they would convert it at that point to a permanent policy. And once again, they can do it without proof of insurability. Now, if they do either one of these, whether it be the renewing to another term policy or converting to a permanent policy, at that point, their premiums would be based on what? Remember, how old are they today? It will be based on their attained age. So let's talk about the difference between attained age, because there's also an issue age policy. Let's talk about issue age. On an issue age policy, the premiums are based on the date the policy was first issued, and they do not change throughout the term. Okay, so it's a level premium throughout the term. So let's say it starts at $50 a month and it ends at $50 a month. It's a level premium. The only way for that premium to go up anytime during the term is if they wanted to increase their benefits. So let's say instead of a $100,000 death benefit, they wanted to increase it to $150,000. So obviously they would have to pay the extra money for that coverage. Next, here's your attained age, and this is your annually renewable term. This is where the premium goes up every year based on your attained age. So on an attained age policy, let's say that the insurance company only starts out by charging $25 a month. Well, they can start out by charging less than they do on an issue age policy because they know every year, what are they going to do? They're going to raise your premiums up. So on an attained age policy, the premiums can start out lower because they know every year they're going to get more money from you. So make sure you know for your test that an attained age policy or annually renewable term has, let me go back here, is going to have the lowest first year premium. Okay, so on a term policy, the lowest first year premium is going to be in annually renewable term insurance. All right, let me give you a quick visual here on your term policies. Once again, you've got your level term, increasing term, and decreasing term. Remember, those are all about the death benefit, nothing about the premium. Increasing term, the only time you will ever pick it is if you see return of premium rider or possibly a COLA rider. A COLA rider is just a cost of living adjustment rider, which means it's going to keep pace with inflation. So that they would use increasing term insurance on that one also. Decreasing term, the only time you're ever going to pick decreasing term is if somebody's gone to a bank to get a loan and they have a credit life policy. All right, now let's switch gears one more time and talk about annuities. Now we talk about annuities because they're sold by insurance companies. However, annuities are not life insurance. Actually, they're the exact opposite. So we have to talk about them because they're sold by insurance companies, but they're not life insurance. So let's look at the difference. First, life insurance is going to create an immediate estate. When you purchase a life insurance policy, let's say, once again, it's a $100,000 death benefit, and if the insured dies the first day of having it, their beneficiary gets $100,000. So life insurance creates an immediate estate. That $100,000 is called the death benefit of the life insurance policy. Next, annuities being the exact opposite. I always tell people when we talk about annuities, think of a 401k. Think of something that you're putting money into so when you retire, you can take that money out. That is an annuity in a nutshell. So annuities do not create an immediate estate. They are actually for the liquidation of an estate. And any money in an annuity, just like if you had money in a 401k and you die, your beneficiary is going to get that money, but it is not considered a death benefit. It's just a return of any principal and interest that you might have gained. So once again, life insurance creates an immediate estate. Life insurance has a death benefit. Annuities for the liquidation of an estate, and they do not have a death benefit. So that is the main difference between the two. Now let's look at some terminology that you need to know about annuities. First, the owner of an annuity is the one that has all the rights and privileges in the policy. The owner of an annuity names the beneficiary and they can surrender the annuity. Now, the owner, they're the one that purchases it or the entity that purchases it, but not necessarily the one that receives the benefits, because the owner of an annuity could be a corporation, it could be a trust, or it could be any other legal entity. However, the person who receives the benefits or payments from the annuity is called the annuitant. Now, the annuitant must be a real, live, breathing, walking, talking person. The annuitant cannot be a corporation, the annuitant cannot be a trust, and it cannot be any other legal entity. It has to be a person, because once an annuity begins paying out, it's going to provide a life income. So they actually need to know how much longer this natural person is going to be on earth if they're going to pay them a life income. So that's why the annuitant has to be a person. Now, a beneficiary in an annuity is the one that receives the benefits from the annuity if the annuitant dies during the accumulation period. What they will receive is either the amount paid into the annuity or the cash value of the annuity, whichever is greater. All annuities have a surrender charge. All a surrender charge is an early withdrawal penalty. That's all it is. All annuities have it. It's going to be different with every annuity. And it goes down every year until after a certain number of years, it just goes away. Annuities are also considered to be structured settlements. Think if you win the lottery, how would you want the lottery paid, the money paid out to you? It would be in a structured settlement. Okay, so think of, you have a question about the lottery, think of an annuity. All right, some more terminology for you here. There are two periods in an annuity. There is the accumulation period, also called the pay-in period. This is where you are funding your annuity is during the accumulation period. Now, all annuities, for the most part, are to get you close to retirement so you can start getting an income. So everybody would have a different length of annuity just depending on your age. So you would fund it during the accumulation period for a certain number of years, and what's going to be different for everybody. After that certain number of years is the date of annuitization, and that begins your next period called your annuitization period. Here are the other names for your annuitization period, also called the payout period, also called the liquidation period, also called the annuity period. These are all different names for that one period in the annuity. Now, getting back to the funding of an annuity or how it's paid for, the pay-in during the pay-in period, the accumulation period, three words that you need to know for your test are either single, level, or flexible. Those words are talking about the funding or how it is getting paid for. Then there are two words that describe the payout of an annuity and when that payout is going to begin. And those words are either immediate or deferred. And here's your definitions for each one. If it is an immediate annuity, that means that the payments start usually within the first year of purchase. So the payout or the income that it starts providing is usually within the first year of purchase. So that's all the word immediate means. The other word about the paying out or when the income is going to start is deferred. All deferred means is the payout starts sometime after the first year of purchase. Could be 20 years down the line. Once again, that's all those words mean on the payout is when it's going to begin. All right, real quick, talk about variable annuities. You might have one question over variable annuities, so I really don't want you to get too caught up in it here. But with a variable annuity, all the words that we talked about earlier are still the same with variable annuities, just like variable life insurance. So let me recap those so you can once again hear it again and memorize the words. Remember, with variable, you have to have your life license and a securities license. That securities license is registered with FINRA, formerly called the NASDAQ, and the oversight is the SEC. You, as the insured, are going to get to pick the underlying investment of bonds, stocks, or real estate. Since you get to pick it, that means there's no guarantees of a return, so no guarantee of cash value. We know the funds are kept in a separate account, not in the insurance company's general account, and we know it serves as a hedge against inflation. Okay, so all of those words are variable specific. Now with a variable annuity, when you put money into it, it's like putting money into a mutual fund where you get shares of a mutual fund, but here they're not called shares, they're called units. During the accumulation phase, they're called accumulation units. So you put in, you know, the amount of money going in every month. However, the number of units you're accumulating is not going to be known each month. Once you annuitize during the annuitization period, then they are called annuity units. Now here, you're going to know the number of units that are going to be coming out. However, the dollar amount of those units are going to not be known until that month. Once again, you might have one question over variable annuity, so I'm not overly concerned about that for your test. And lastly, equity indexed annuities, once again, tied to the S&P 500. Okay, and remember, it seeks higher returns. And you might have a question about what type of license or licenses you need to sell equity indexed life insurance or equity indexed annuities. And you need to know it is a life license only, okay? Not securities license, because securities license is only going to be with variable up here at the top. Okay, so equity index, it's a life license only. All right, so let's finish up this chapter with some payout options for your annuities. Remember, annuities are designed to provide a life income. It's an income you cannot outlive. There's a single life payout or a straight life payout. That's payments for the rest of your life. But if you die too soon, the insurance company is going to keep whatever's left in there. Let me go down here to maybe I want payments for both me and my wife. I could choose either a joint life payout. That's going to be payments for at least 2 people, and they're going to stop after the first person dies. Or I could choose a joint and survivor payout. That's payments for at least 2 people, but the payments won't stop until after the second or last person dies. So this terminology, joint life and joint survivor, are going to come in handy 2 more times, and it works the same way each time. A couple of other payout options on your annuities. It might be a life with period certain payout. That would be a life income for the annuitant. For the annuitant, I mean, they could choose like a 20-year period certain for their beneficiary, so that if they died sometime during the first 20 years of payments, then the beneficiary gets the remainder of the 20 years. If the annuitant lives through the 20 years and then they die, the beneficiary doesn't get anything. They have to die during the period certain for the beneficiary to get anything. The most popular payout option here is going to be a life with refund. That's a life income for the annuitant, but if they die too soon, then the beneficiary does get a refund of whatever's left in there. And lastly, let's get back to some life insurance policies. Let's say my wife and I need some life insurance, but we don't have a lot of money. And you're our agent, you come to our house and you say, John, instead of buying 2 separate policies, why don't you all buy 1 policy that would cover both of your lives? That will be a lot cheaper. I'm like, okay, hit me with it. John, you could choose a joint life policy. That's 1 policy covering 2 lives, and the death benefit gets paid when the first person dies. Or you could choose a joint and survivor policy, also called survivorship life, which is 1 policy covering 2 lives. However, the death benefit doesn't get paid until after the last person dies. And so I ask you, Mr. or Miss Agent, you know we don't have much money. Which one is the most affordable for me and my family? Is it the joint life or the joint and survivor policy? Well, let's look at how the insurance company would treat each one of these so we can figure it out. On a joint life policy, 1 policy covering 2 lives, but the insurance company would have to pay the death benefit after the first person dies. And then the policy would go away. Well, my wife could kill me tomorrow and they would have to pay a death benefit. Okay, so that one is going to be more expensive. The cheaper option would be the joint and survivor policy. That's where they don't have to, even if she does kill me, they don't have to pay the death benefit till after she dies. Okay, so the more affordable of the 2 would be the survivorship life policy. All right, that's going to do it for your types of life insurance policies. Now get onto your exam simulator and do some practice exams over this section, and we'll see you on the next video.